Today on Retire with Purpose, hidden fees that might be lurking inside of your mutual funds, how you might be able to use life insurance to cover long-term care in retirement, and what you need to know about the three worlds of money.
Are you prepared to retire with purpose? To retire knowing your savings is invested to meet unavoidable needs and expenses.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Certified financial planner Casey Weade is president of Howard Bailey, an advisory firm that believes successful retirement begins with a detailed financial plan personalized to help achieve your life's purpose.
Whatever risk you faced, we've got a plan.
The Howard Bailey team is committed to practical financial planning so you can enjoy family and the future without uncertainty or stress. Stay tuned and learn how you too can retire with purpose.
Welcome to the program. Good to see you. I am Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're beginning today with some information that you'll find in an article published in Forbes magazine called Comparing Mutual Funds to ETFs and SMAs. Now, those are quite a lot of people have ETFs or have mutual funds in their portfolios these days. So let's walk through what all those things are and when we might want to use them.
Yeah, most people understand what a mutual fund is because they've become very accustomed to it. They've gotten used to investing in these things throughout most of their investing career in their 401ks and brokerage accounts and IRAs. Brokers have been offering these types of investments for decades. And so most people understand what they are. But when you have ETFs now, you have SMAs, you have UMAs, it can become kind of confusing what each one of these different vehicles are and the pros and cons of each. And I think this article really did an excellent job of breaking down the pros and cons of each of these and when you might be able to take advantage of the benefits of one over another for that matter. So when it comes to mutual funds, we typically understand what these are. These are pooled investment vehicles, but I think this is where most people have a misconception. They think that they own stocks, they think that they own bonds, but really the mutual fund is investing in stocks, it's investing in bonds, and then you actually own a share of the mutual fund. You own shares of the mutual fund itself based on its net asset value. You don't actually own any individual securities. Now, when it comes to exchange traded funds or ETFs, these are really mutual funds that are exchange traded. So they trade throughout the day. So you can trade them much like you would an individual stock, for that matter, throughout the day, and that's a little different than a mutual fund that can't be liquidated until the end of the day value. That's the value that you end up with. And so day traders tend to like index funds and ETFs a little bit better for that reason. And ETFs typically focus more on indexes themselves, tracking the S&P 500, the price of gold, the Russell 3000, tracking certain indexes, meaning that the trading cost is lower because there's just not as much turnover, but they're still pooled investment vehicles. So you own that fund just like a mutual fund with a million other people, potentially. And then you have a more recent iteration called a separately managed account or an SMA. And these have been developed over the last 20 years and widely growing in popularity. And these vehicles allow you to have that professional management that you would experience with a mutual fund, but you get total transparency. You actually own those individual securities. So you own those stocks, you own those bonds, you own them directly, and as of the date that you actually invested and made those purchases. A unified managed account is the latest iteration of really a separately managed account with some enhanced benefits. One of the downsides of SMAs or separately managed accounts was that sometimes if you wanted to have multiple professional managers and diversify a little bit across different investments, well, you had to have separate registrations and separate account numbers. That meant your statement turned in from 5 pages got to be 50 pages long, and that got to be a little confusing. And now we have unified managed accounts that allow us to have the benefits of an SMA, but we can have multiple professional money managers, multiple SMAs, individual stocks, individual bonds. You can own mutual funds in there, but it allows you to have a lot of different investments under one registration to simplify that process and have lower minimums in order to have that diversification.
You said lower minimums, but still with an SMA or UMA, those are typically vehicles for people who are a little higher higher on the portfolio range, right?
Sure. When you look at these different vehicles, you might start with mutual funds and understand that these are really mutual funds and ETFs. I mean, they were both really created for the retail investor, the typical person that's walking off the street into their brokerage firm or hopping on E-Trade or Scottrade and trading online themselves. These were typically made for smaller investors that are buying into individual securities. I mean, take my son, for instance. You know, he's going on 4 years old, and he owns a mutual fund. And he owns some ETFs as well inside of his 529 plan. And you know, there's only a few $1,000s inside of that plan, so he wouldn't have the luxury of getting professional management on a larger scale in a separately managed account or in a unified managed account. And so he is investing like a retail investor would. There becomes a certain point, though, when you accumulate enough dollars that you kind of grow out of that stage and you can graduate from the retail world where there's hidden fees and hidden costs, lack of transparency, tax inefficiencies, and you can make that move into a separately managed account, maybe a unified managed account. And those account minimums are usually $100,000, maybe as high as $250,000 or $500,000 in order to get those benefits of an SMA or a UMA. But if you've gotten to that point, I mean, we've sat down with investors that I had a gentleman the other day that we sat down with, and he's got a portfolio. It's $1.5 million, $1.5 million. He's investing in the same mutual fund that my 4-year-old son is. It's like, well, hey, you are not 4 years old. You've accumulated a lot more than that. You deserve something better. And we were able to move him someplace where he got better cost, where he should have better performance. And that's one of the things that this Forbes article pointed out. When it comes to performance, mutual funds, ETFs, they have a long track record of underperforming the indexes that they're supposed to be tracking in the case of an ETF, or the indexes they're benchmarked to in the case of a mutual fund, where SMAs and UMAs provide typically better performance.
One of the things that people don't really understand about mutual funds is that tax risk. I mean, they're not very efficient from taxes and fees and other elements, right?
Yeah, exactly. If you look at the pros and cons of these, the biggest downside or the biggest benefit, depending on which side of the coin you're looking at, mutual funds or SMAs, is we really like to look at taxes. We like to look at cost. When I first got into the business of financial advice, if you want to call it that, it wasn't really offering financial advice. I was trained as a salesperson. That's how every single person that you're ever going to sit down with that got into this business, they weren't trained as financial planners or financial advisors. They were trained to sell products. And that's the way I was. They would sit down and say, hey, here are these 5 different mutual funds, and this is their track record. This is how they work. It's really not too important that you know how they work real well. You just need to know the track record. Go down, sit down with people, analyze their past portfolios, and then sell them this mutual fund, and here's some sales language for you to use. And I could sit down with people and say, okay, it's averaged 8% a year. Last year it made 20%, but I didn't know what it was going to do next year. Is it going to lose money? Is it going to, instead of averaging 8% like it used to, is it going to start averaging 5%? Or is it going to be a negative for the next 5 years? There weren't any guarantees. And so I really started digging in, going, well, where are the guarantees in the world of financial planning that we can possibly get? And as people often say, there's only 2 guarantees in the world, period. That's death and taxes. So why don't we plan around those things? And so one of the things we can do with our investment portfolio, mutual funds and SMAs, UMAs, ETFs, is analyze the tax consequences of investing in these vehicles in the first place. We reduce our taxes, we should increase our rate of return. At least we know we're increasing the benefits. We can't control the market, but we can control taxes. Right. We can control cost. When it comes to taxes, mutual funds, as outlined in this Forbes article, are one of the most tax inefficient vehicles we can invest into. And ETFs have a similar problem. Because of this pooled nature, when you buy into these funds, you're buying into something that has capital gains that have yet to be distributed to investors. And when you buy into it, let's say you bought into a mutual fund today, or an ETF for that matter, if you buy into that fund and then it has a stock in there that has a lot of gains, and over the next, before the end of the year, they decide they're going to sell that position, they sold it at a gain, right? They sold it at a gain, but you bought in, and over that period of time, you lost dollars through the end of the year, but it kicked out a capital gain. So you ended up paying taxes on something that you didn't actually experience a gain in, something that you didn't benefit from. Warren Buffett once said, don't spend money on money you're not spending. And that's what you're doing when you own a mutual fund or even an ETF. ETFs aren't as big a culprit to this as you see mutual funds being, but they still have that nature. And this is when you want to start looking at those after-tax funds that you have and maybe moving them over to an SMA or a UMA where you own those individual securities. So when you buy in, if your manager decides to sell that position before the end of the year, well, you're going to be able to take a loss because you experienced a loss. You're going to be able to take that loss, much more tax efficient. And when it comes to a cost standpoint, you're typically going to get lower costs with the SMA or UMA. And if nothing else, you've got the transparency to know what your cost actually is in the first place. When it comes to mutual funds, this is the biggest culprit of higher expenses. The Wall Street Journal, also Forbes, did an article that outlined that the expense ratio in the average mutual fund on average will double. Actually double once we include the transaction cost that is not disclosed in that expense ratio. And that means the average fund being 1%, it might actually be costing you 2%. And when you look at SMAs and UMAs, you either see that transaction cost, or in the case of our firm, when there's trades being made inside of the SMA or UMA, we're covering that cost for the client. So they know every time there's a buy, every time there's a sell, we're doing that for their benefit. I love opening up my statement and seeing trading on an active basis because I'm paying them. They better be doing something.
Well, if you'd like to learn more about exactly what's going on in your portfolio, we have an opportunity and an invitation really for you right now, and that is to call the number in your screen before the end of the program and sit down with a member of the Howard Bailey team to take a look at exactly what kind of fees and expenses might those mutual funds in your portfolio be generating that there might be a way to escape. We'll take a look also at how much risk could be hiding in your portfolio and how exposed could you be in a market downturn. We'll also take a look at, is there an opportunity for creating a lifetime income that you cannot outlive? All very important factors that you'll review in your complimentary retirement review with a member of the Howard Bailey team. If you call the number on your screen before the end of the program, it's an important meeting that'll get you started toward retiring with purpose. All right, we are coming back in just a second answering your questions. Stay with us.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
Welcome back to the program. It is time for us to answer a question about life insurance from Steve in Granger.
Casey, do whole life insurance policies include long-term care benefits?
Well, Steve, that's a great question and kind of a unique one because you're seeing more of this today than you used to, but it's not very typical. So there aren't a lot of life insurance policies out there today that offer inherently long-term care benefits, but there are some that do. When it comes to whole life insurance, you can find some products out there that'll offer the ability to accelerate a death benefit, for instance. So you make a deposit to an insurance company of, say, $100,000. They provide you with a death benefit of $200,000, and then they may provide you a monthly long-term care benefit of, say, $4,000 a month. And so you end up having a long-term care need, then it's going to start to pay you that monthly benefit, that monthly long-term care benefit, until that death benefit runs down to zero. And then you no longer have any long-term care benefits, you no longer have any death benefit. But the good thing is that if you never use the care, you still have a $200,000 death benefit that you could pass on to your heirs. And there's one company in particular out there today that offers a continuation of benefits rider. So in most instances, that long-term care benefit, once it's drawn down to zero, that pool of $200,000 goes to zero, then you're out of benefits. But this company, and there's some others out there with different variations of this, can allow you to apply a rider and pay an annual premium a little bit more like a traditional long-term care policy, where you might pay an extra $100 or $200 $200 a month to make sure that that benefit is unlimited. So once you draw down the whole $200,000 death benefit, they'll continue to pay that $4,000 or $5,000 a month, whatever that monthly benefit is, for as long as you live. And the reality is these types of policies have become now more popular and are being used more widely than traditional long-term care insurance for several different reasons. One of the biggest reasons being the use it or lose it nature of traditional long-term care insurance, which people don't like. And the other one, which has been increasing long-term care premiums over time. We don't know what that premium is going to be. If we buy a policy today, we don't know what's going to be 10, 15, 20 years from now. And this is one of the reasons I tend to shy away from traditional long-term care insurance. We still find the use for it for the right situation, but for most people, it's just not the best fit. And in part, I don't want to be sitting across from someone 10, 20 years from now and have them say, I can no longer pay this premium. That means I put them in a very bad situation. I think what you need to do, though, Steve, is rather than just looking at whole life insurance, look at the whole litany of options that are out there, whether that's universal life insurance, whole life insurance, annuities, and evaluate traditional long-term care insurance, even evaluate the use of a Roth IRA for that matter, and see which one might be right for you, given each one's pros and cons and your personal priorities.
Insurance is also on the mind of Jane in Defiance.
So what are your thoughts on return of premium life insurance? It seems like a good alternative to term insurance, but I'm no expert.
Well, Jane, thank you for your question. And I kind of lean towards the Dave Ramsey thought on term insurance, where we buy term and invest the rest. And I guess if we look at return of premium life insurance, it's much like that. So if you end up buying a return of premium life insurance, just to share with you how that might work, maybe you pay $1,000 a year for 10 years, and it's a 10-year term policy. After 10 years, you get back all the premiums you've paid. So over 10 years, you paid $10,000 in premium. They give you back your original $10,000. So you never actually had an expense that was outside the door. But just for number's sake and for understanding, we could say, well, we could go out and buy a term policy that does not give us any return of premium benefit for $500 a month. And over that 10-year period, we end up spending $5,000 in premiums, but we could have taken that other $5,000 and we could have invested it somewhere in, say, a Roth IRA, and we would have been net better off over that 10-year period. So just make sure you don't, I think where we get stuck here is someone says, oh, well, you can have your money back at any time, or you can have your money back in 10 years. You never have an expense. You still have an expense no matter what the benefit is, whether it's return of premium, whether it's an income rider, whether it's a death benefit rider. There's always an expense to anything that you do. Nothing in this world is free. So make sure you really evaluate all the alternatives, much like we told Steve.
And Harold from Fort Wayne writes in with this email, I'm looking at taking a lump sum pension or a life annuity. If we need the income, which is better? A lot of people face this challenge.
Yeah, are we going to take a lifetime income? Are we going to take the lump sum pension? We're seeing this a lot in a lot of the different communities where we have offices, where there's just been this push, where we're seeing people being pushed out of pension plans because they're becoming very expensive. People are living longer, interest rates are larger or lower. It's harder to make those payments that were promised to them. So they want you to get out of these plans. They pay you a lump sum, or you continue to stay in the plan and they give you a pension benefit, a lifetime income. And the first thing you have to ask yourself is, do you need the income in the first place? So do you need the income? Do you need that monthly benefit every single month? If you don't need the monthly income, then it might hurt you tax-wise in order to take that income. You might be better off taking the lump sum and rolling it over to an IRA and keeping it tax deferred, maybe even doing some Roth conversions along the way. So you want to evaluate whether you need the income benefit or not. If you need the income from that lump sum, then I would say evaluate taking that lump sum and going out and buying a private annuity and getting potentially a higher level of income than you could get through the employer. And we find this quite often today. You can get a higher level of income utilizing the lump sum and buying yourself a private annuity somewhere else through, say, an insurance carrier. And you can also retain greater control over the dollars. You also want to evaluate something called pension maximization. You might want to take the single life benefit instead of the joint life benefit and take the difference and buy life insurance with that difference. And that'll provide your spouse or your loved ones with a lump sum if something were to happen to you. And that's one of the things people don't like about the pension payment is if I pass away next year, well, I only received X amount of dollars. I didn't get all those dollars that were left in there, never get paid out to anybody. So you have a lot of different options. I think you need to evaluate all of them, just like we said to Steve and Jane a little bit ago. And, you know, just also thought, you know, on Jane and Steve's question, there's a little bit of a crossover there talking about term insurance because I recently had a couple we worked with. We implemented a long-term care strategy with a long-term care product that was meant to create long-term care benefits. And then they said, well, what if I have chronic illness, or what if something happens where I become disabled? I don't need a long-term care provider to come into my home, but I need some extra cash. And we said, well, why don't we take these old term policies you have, we can replace them with new term policies that have chronic and disability benefits that accelerate some of that death benefit so you could use it on a cash basis for those other things. So I guess, you know, just common theme here, there's a lot of different options.
And I think that's a great reason to pick up the phone and call the number on your screen right now, because it is a complex world out there. And what's more important in your retirement? And a review of details in your portfolio is something you'll receive when you sit down with a member of the Howard Bailey team and take a look at all these factors, the insurance factors we just discussed. Also, fees and taxes you might be paying that you might not have to. Also, how much risk is lurking in your portfolio when that big downturn comes in the market. Is it going to hurt you? Will you have time to make it all up? Things worth considering, and we'll review that with you as you sit down with a member of the Howard Bailey team for this complimentary retirement review. So be one of the next people to call the number on the screen before the end of our program and schedule that appointment. It's time well spent. Put you on the road toward retiring with purpose. All right, here's our question of the day. It has to do with the average CD rate from January of 2000. What was that rate way back then? We have the answer when we come back.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
Our question of the day takes you back to the year 2000, and we're asking, what was the average 5-year CD rate in January of that year? Casey, this really surprised me.
Yeah, the average CD rate in January of 2000 was 5.5% a year, according to Bankrate.com. And you know, one of the questions I often ask people is, well, what did you have a CD for back in the 70s or 80s or the 90s? And often I'll hear, you know, 10% or 14%, 15%. And I'll say, you know, if you could get a 15% CD today, FDIC insured CD, 15% fixed, you'd take the longest term that you could get, and would you even be sitting here having this conversation? They'd say no. Yeah. I wouldn't even need you, right? I'd probably have enough income to last the rest of my life, probably preserve my principal, take care of emergencies, take care of health care costs, and maybe even have some dollars left over to leave behind for my heirs. But that's not the world we live in today. And this is a good part of why we see more and more people seeking financial advice today, more so than they did 10, 15, 20, or 30 years ago, is because, one, people are living longer and interest rates are much lower. This is why they called this the war on retirees. And so one of the things that we like to do when we sit down with people is walk them through all the different options they have today outside of CDs. And this is especially important as we step into retirement. We call this discussion the 3 worlds of investments. And the 3 worlds of investments starts with the world of safety and guarantees. And in the world of safety and guarantees, as in all 3 of these different worlds, we're going to have pros and cons. So let's talk about some of those pros and cons, these basic attributes. This is a place where you're going to have a guarantee of your principal. So your principal is going to be insured by some type of legal reserve system. Number 2, you're going to have a fixed guaranteed interest rate. You know what it's going to be next month, next year, and beyond. Then you have a fixed term. You know if it's going to be 1 year, 5 years, 10 years, and that's going to be that penalty period, because there's going to be penalties for early withdrawal during that period. As in the case of a CD, if you have a certificate of deposit, typically if you withdraw the whole thing, you're going to have penalties of, say, 6 6 months. And there are some CDs out there that have actually penalties on your actual principal, so you have to watch out for that. But most of these also have free withdrawal privileges that allow you to take interest only, or 5 to 10% per year. Today, we're seeing somewhere between 0 and 4% in this world of fixed rates and principal protection. Then you have this hybrid world. This hybrid world came about back in the mid-'80s by Chase Manhattan Bank inventing back in 1985 the equity-linked CD. In this world, you have the principal protection figure, and take that equity-linked CD. As a CD, it's giving you principal protection, but it's linking your rate of return to something in the market, so you have more growth potential, and you have a fixed term, much like a CD or a fixed annuity. You know that you're going to own this for 1 year, 5 years, 10 years, 15 years, and there's going to be withdrawal penalties during that period of time, and your growth potential is going to be somewhere between 4 and 6%. There might be years when you have no interest. There might be years when you make 10%, but over time we hope to make 4 to 6% a year. In a bad market, maybe it's less. In a really good market, maybe it's a little bit more. Then we have the world of risk, the world of investments that you're really most likely accustomed to. This is a world where your principal is at risk. We can take losses. We can lose the value of a stock. We can see the value of a portfolio go down from time to time, but for that we have more growth potential, and most of the time we have more liquidity. We can sell a stock, we can sell an option, we can sell a mutual fund by the end of the day. We can be liquid by the end of the day. Not all the time. Some of these are illiquid investments, such as real estate investment trusts, or maybe even a bond or a variable annuity, and there's no term here. There's no term typically, but with some of these there is a term. When it comes to growth potential, we expect long-term averages, if we look at the stock market, of 6 to 10%. That's a 10 and 30-year rolling average of the S&P 500 over the last 100 years. So when we look at these things side by side, what do you hear from your banker? Well, they want to keep you in your CDs or place more CDs. When you look at your broker saying, well, this is the world you need to be in. Look at the long-term averages of the stock market. And you don't want to be in those fixed places. We can earn you a much higher rate of return. Then you have the insurance salesman that says, well, we have to put you in annuities or fixed index annuities. This hybrid world's the only way to go. The market's going to lose a tremendous amount of value in the future. The reality is all three of these worlds might be a good fit for you. And we just have to identify what that purpose is of those dollars. Is it for long-term emergency funds? Is it for income dollars that you can't afford to lose, but you need a higher rate of return? Is it for long-term growth and inflation protection? It depends on the need of the dollars, the purpose of the dollars, as you make the decision on which one of these worlds you're going to use for your future. And not every advisor, especially if they're not independent, will have access to all three of these different worlds.
That's why I think it's really important to understand who are you sitting down across from and what is their role. Are they a salesperson? Are they an advisor?
That's right. We want to sit down, make sure we're working with an independent financial planner that's not a broker, someone that carries a Series 65 securities license, where they are investment advisor representatives, they are fee-based, and they're not brokers. What's broker mean? Well, if I'm carrying a 66, a 7 securities license, I'm a broker. I'm representing a company and I'm selling their products. You know, we know what a broker is, and that's what most financial advisors really are.
And when you sit down with a member of the Howard Bailey team, it's an independent voice to help you make a really smart decision about your future. So call the number on your screen right now before the end of the program, which is just a few seconds away, and we'll get you on the calendar for a meeting with a member of the Howard Bailey team, an independent advisor to help you understand risk in your portfolio, fees and taxes you might not have to pay, provisions for long-term care, and a lifetime income you can't outlive. All very important things we'll cover in a complimentary retirement review when you call the number on your screen and sit down with a member of the Howard Bailey team and put yourself on the course toward retiring with purpose. That's what we're all about, and we will see you next week. You take care.